Hi, this is Amelia Cox. I am doing the Chapter 8, Example 11 in our Financial Accounting textbook. You can find the example on page 421, but I have written out the transactions right here. So we're supposed to do, so these are transactions that took place for the Bramson Company. And the instructions are to record the transactions in the general ledger, or general journal, I apologize. The company does not make entries to accrued interest except on December 31st, which is important for us to remember. So the first transactions that we need to journalize is on the 1st of May. And it is, so we received a $5,000 12-month 6% note in exchange for an outstanding accounts receivable from R. Stoney. So what we are first going to do is we are going to first put in the notes receivable. And usually this happens because someone isn't able to pay quickly on the accounts receivable, and so they want to switch it to a notes receivable because they'll have a little bit more time to pay that back. So it is a $5,000 note, and so we put in the debit for notes receivable $5,000, and then the accounts receivable $5,000 because we've already put it in the accounts receivable for, so we're crediting it to switch it over to notes receivable. Pretty simple. But then on December 31st, it says that we accrued interest on the revenue, or interest revenue on the R. Stoney note. So December 1st is our next transaction. And so first of all, we need to figure out the interest that is due. So first we want to take the amount of the note and times it by how much interest, just so that we can get an idea of how much we are going to earn by the time they pay it off in that 12-month period. And so we take 5,000 and times that by the 6%, and we get 300. So by the end, when they repay that note, they will have accrued $300 in interest. But this is December 31st. I apologize, I made a mistake there. It's the 31st, not the 1st. So on December 31st, it hasn't been the full 12 months yet. So we want to, first of all, at least how it makes sense in my mind, is to just see how much we will be accruing every month. So we take the 300 total and divide that by the 12 months that the interest that the note is going to be repaid by, and that equals $25. So every month they accrue $25 of interest. So if we take when they first received the note, and then see how many months from May 1st is to December 31st. So you have to count both the month of May and the month of December, because it's the beginning of May and the end of December. So that is a total of 8 months. So we take that $25 every month, and so far we've had 8 months. And so by the time they are accruing interest, that is $200 that they have accrued. So to journalize that, we would first debit interest receivable, and that is the $200 that we just figured out. And then we have since we have earned this interest by having that many months, we would credit interest revenue by the $200. Okay. And now, in 2017, on May 1st, we received the principal plus interest on the R. Stoney note. So no interest has been accrued since December 31st, meaning we haven't accounted for any interest. Doesn't mean that we won't receive the interest, because we will receive the $300 total at the end. So first we put in the month, and since we have received it, we are going to debit cash. And cash is going to be the total amount, the note plus the interest that has been accrued. So the total is going to be $5,300. That is how much we will receive. And next, the notes receivable. We want to credit that to show that we have received that payment, and they no longer owe us. And so that is going to be the $5,000. So that counteracts that. And next, the interest receivable. Because they are now paying that back, we want to credit that by the $200 to show that once again they have paid on that interest receivable. But there is one last step, because they have so far only paid $200 worth of the $300 interest. So we have to put that in now as interest revenue, because they have paid it, and that's the remaining $100. So the $200 that was accrued on the December 31st, and then the $100 that is now accrued because they have paid on their receipt, or on their note. I apologize. So hopefully this makes sense. If you have any questions, please comment below, and good luck with your homework.